Okay, I am going to start giving this a whirl. This is a test. I've never done this before. I spend a lot of time thinking about investments and goofing around with my money and all that kind of stuff. And usually I've made videos in the past. I'm going to start just doing them live. And if anybody on the earth is ever logs in and sees this and has a question or wants to talk about something, then put it in the chat. And if I know anything about what you're asking about, I'll talk about it. And if you miss this live and you're watching it for some reason, which is bizarre, you can just put it in the comments, and next time I do it, I will do it. So what I'm going to do is, instead of just sitting here at my computer researching my investments and doing my noodling and thinking about investments that I do, instead of just doing it alone, I think what I'm going to do is just start filming it. Because I just sit here and I research stuff. So I'm just going to share my screen as I'm doing it and just kind of go through what I do to keep track of my money. And I tell you what I'd really ultimately like to do is have like a group, like an investment club almost. I just don't know how to do that. There's nobody really in Nashville that I hang out with that wants to sit around and talk about investments too often. My son we talk all the time about money, and we enjoy talking about it, but this is just a way to talk to maybe more people. And like I said, I don't know if anybody will even care about any of this, but I do this anyway, so I figured I would just put it out here and see what was going on. And I'm literally in my house, so you're going to hear people walking by, opening doors, screaming and yelling, and that's fine. Just move along. So one thing that I do is I post everything I do. I post it on my Twitter account. I put it on my website at www.DeanoRolls.com. And every month I look at my performance and I figure out, did I do well? Did I not do well? And one thing I look at is so I look at my portfolio and I track my performance. I started a company out of college that we did investment performance, so I kind of know how to do all that stuff. And I track my portfolio, and I've been tracking it for 29 months. I've been keeping track of every trade and every move of every dollar and every account. And I basically track myself against a blended portfolio, and what that does is it moves against, like if I'm in bonds, my portfolio benchmark becomes weighted in bonds, and if I move out of bonds, it becomes weighted in not bonds. So long story short, last month, in the month of March, it was like an April Fool's joke when we calculated performance this time, because the performance was horrible during the month of March. I mean, that is the nastiest looking chart. If you had money, you don't have as much anymore after the month of March went by. Just disgusting charts. And I'm going to look at some charts on some of my individual stocks. Now, I was down 17%, it says up here at the top. So I was down 17% in my overall portfolio. And to tell you how bad that is, I'm not even in stocks 100%. So it's pretty abysmal. I mean, I've got a pretty good bond position, and I've got commodities, so I've got precious metals, and we'll talk more about that, but just got obliterated. And the reason is because the individual stocks that I own got obliterated during the month. And then some of the money I moved, I was kind of overweight in some of the sectors that got just pummeled, energy and financials. So we'll talk more about that, but horrible month performance-wise. And I don't guess I have anything else to say about that. I titled my blog post this month, "Do you know that I'm not an alpha male?" And I'm definitely not, because in order to generate alpha, you're supposed to pick individual stocks that do better than the market. And I definitely didn't do that. Now, I do want to talk a little bit. So that's just me against benchmarks. Now, I do want to talk a little bit about my allocation. So back in February of 18, I started doing this in October of 17, keeping track of it, and starting to buy individual stocks. So you can see in November I got going. I went 100% equities, all in on stocks, and the market was ripping at that time. And then I think Trump had just been elected, and it kind of ripped and roared until February. And February had this it had like a really kind of a blow-off-ish top, where in February it just went really gangbusters. And at that point I was like, this is crazy. And I sold a little, went to bonds. And then over the next couple of months, you can see in April, I started to get less and less in stock. And by the middle of the year, by June and July, I had really pared back my stock exposure. I'd started buying precious metals at that point, and I had never bought precious metals in my life. I had a pretty decent-sized bond position. I was sitting on cash. We sold our personal residence and downsized to our little condo for all kind of reasons, but money was part of it. I mean, I just didn't want to own a big house going into what I thought was going to be. I didn't want to have excessive money tied up in a house, for sure, going into, if we were going to go into a recession. And I didn't think we were going to go into a recession then, but I did not like the way the assets felt bubbly, and I did feel like things were kind of moving in the right direction towards recession land. We had a good run for a while. So you can see my stock exposure is the green. So you can see I've really lightened up on stocks during that time, and I've really liked the yellows, international stocks, and then I blew up a commodities position that's a pretty big position for me now, and that includes things like precious metals and commodities. It's got some Bitcoin in there now, and then you can see my bonds. I don't want to own bonds at all. I mean, I hate owning bonds. I hate owning bonds now, but I have a couple of kids in school, and my what I do for a living, I own a company, and we could go out of business tomorrow, and I would still have to put my kids through school. So right now I'm sitting on a little more in bonds, just because it's almost an emergency fund, not really, but I want to be a little more liquid than I would normally be. Just because of that. If I didn't have that to worry about, I would be way more aggressive in my portfolio. And I don't keep track of things like my checking account and this, and I've got other money that I keep more liquid, but I still do have some liquidity, because what I didn't want to do is, if the stock market did drop 50%, I didn't want to have to, and then we are also in a recession, and then my company messes up at the same time. What I did not want to do is get into a situation where I'm having to unload perfectly good assets to fund my life. So I'm just playing it super safe on that kind of stuff. So, what my target allocation right now in bonds is 15% of my portfolio, and that is literally just to be super safe. And I would like to have 0% in bonds, because, to me, bonds, you're going to get beat up. Inflation's going to outpace you. It's just stupid to own bonds. It just really is. For someone like me, I'm almost 50, late 40s. I'm going to hold this is not stuff I'm going to be liquidating anytime soon. This is my life's money. So bonds is nowhere where I want to have that in a inflation driven world, which we're going to be in. So I'm probably as light as I've ever been on stocks, and that's by design. I came from, literally, you can see back in here, I was 100% stocks, and I'm perfectly fine being 100% stocks. If I can find stocks that I think are cheap enough, I just think the stock market in general is way overvalued, and I hear people talk about interest rates and all that kind of stuff, and I don't care. You can read anything I wrote over the last couple of years, and I just think stocks are overvalued. And I just don't want to have everything tied up in them. I think commodities have been just obliterated for the past decade. They a lot of oil and stuff, all that was coming off highs in the financial crisis. But to me, I just feel like I get more value out of my commodity exposure right now because everything's just so beat up, and it's getting more beat up. In the month of March, I mean, oil got absolutely obliterated in the month of March. The Saudis and the Russians all are they're in a price war with the U.S. They're trying to shut down the U.S. shale industry, and I don't care about all that, but, I mean, oil's just getting crushed. Commodities in general, there's no velocity in the money supply. So, I mean, we've got no inflation. Everything's deflating. The only thing that's inflating are asset values, and that's because the Fed is just pumping money to keep the asset values propped up. And I just don't really think that's a sustainable situation. It has been for a couple of decades, but I mean, it doesn't make me feel. I didn't sleep well at night. I guess the reason I really started doing this is my son got into investing, and he wanted to learn about it. And I'd done stocks before and goofed around with it, but really, kind of paired with that is I was just not sleeping well at night because all that stuff I just talked about was really freaking me out. So, that's not the case anymore. I mean, my portfolio, the way it is, I mean, the market got obliterated in the month of March, and we were on spring break, and I watch it. I mean, I enjoy watching it, so I was on Twitter, but, I mean, it didn't stop me from going to the beach, and I wasn't logging in and updating anything. I was making no trades. I lost no sleep, and the market was down 28% during the month. That was not the case a couple of years ago. So, and that all has to do with how I'm allocated here. The world right now with coronavirus and unemployment going through the roof, and there's all these new laws being passed which have impacted my company. I mean, there's plenty to be stressed about, and I just haven't really been that stressed. That's not the same as it was in 2008. I mean, I was stressed in 2008 because, I was more levered, and when you're levered, I had a big house, small income for that age. I had a bunch of kids, working my tail off, but I had a lot more leverage in my life at that point, and I had a lot more bills to pay, and I didn't have as much money. So that was stressful. And then the money I did have went away. I mean, in 2008, top to bottom, stocks dropped hugely. And I'm not convinced they're not going to do that now. So I don't know. Nobody knows. I don't try to day trade. I don't try to swing, and I don't try to time the market. This is a portfolio. The allocations I'm with right now, you can see I'm under allocated in stocks. That's the lowest stock ratio I've had in a long time at, 57%, and I should be at 65, but I'm not plowing money into stocks right now. I've been kind of chasing it over the last 6 months just to get my sector allocations correct. But I'm not chasing it at this point. I'm going to hold on to my commodities. I'm at 25%. I'm over in commodities. During the month of February, I'd lighten that up a little bit. And, I don't make big moves with my money month to month, but I'll tinker with it. It gives me something to do. But the problem is the market's moving so much faster than I'm able. I have rules with how much money I'm going to move and not move. And the market's just moving so fast in some of these areas that I can't catch my allocations and get them correct. So if it'll sit and not move for a while, over months I'll catch it. But I'm just not going to move big chunks of money in a short time frame. So, if anything now, I'm a little over in bonds, and I'm thinking, I'd like to get that bond ratio back down because, stocks are cheaper than they were. But I don't have any I've made my transactions for the month of April right now, and I don't really have any plans to do anything else for the month of April. There's one thing, which I'll talk about in just a second when I get to it. So that's how I'm allocated and why I'm allocated the way I am. And then these are all my positions, and I'll probably jump around here. So, because this is what I do. Once a month, I look at this, and I'm like, what in the hell happened? So let's start at the top, bonds. So I don't have TLT. I don't have a long-term bond portfolio. I have all of it in a super short duration, It's basically cash for me. At least that's what I think it is. I mean, it's a 1 to 3 ultra short Treasury bond portfolio. So there's nothing that's more than 3 years in it, and it's generally less than that. So it's not sensitive to interest rate swings. So if I'd have had longer term bonds, I'd have made a lot more money because the bonds rates have been dropping like crazy. But that's not really my goal with that. It's been really just to park money and have it available. And I didn't want interest rate swings up or down. I mean, I would have taken a down, but if all of a sudden bond rates start going back up, I don't want to start losing, money in my bond portfolio, because my bond portfolio is liquid, which is why I have it in treasuries. I had it in like short-term corporate bonds, and I even got out of those because the yields on the treasuries were just as good. It's like 2.3%, I think, is what I was getting on this when I got into it. And then I've got a little bit of money in cash. Most of that, it's less than 1%. And most of that's just, I don't reinvest dividends on anything. So I do it manually every month. So if I'm under allocated in something, I'll let a dividend come in, and then I'll use that to get my allocations corrected in the next month. So I got a little bit of cash that I'm reinvesting, and I've actually already done that. It's April the 6th right now, so I've already done that for the month when I made my normal transactions. I own commodities. Now, my bucket for commodities is not really commodities, maybe. Some people would say gold is not a commodity, that it's money, and that's what I think. It's why I hold it. It's because it's held its value for 5,000 years. And I've got a write-up about why I bought gold. I've never owned gold before in my life until a couple years ago. So I've got about 10% of my portfolio is in gold. And it's actually up since I bought it. I'm up 26%. So you can see on here I have what I bought it for and what its current price is. And I have when I bought it. And then what it's up or down. And gold's been great, been a good investment for me. I bought silver. I opened my silver position actually a month before my gold position, and it's down 16% from when I bought it. And silver got pretty beat up during the month of March as well, and gold held its own. So I'm not quite sure what that's about. But the silver to gold ratio it's the highest it's ever been. It's like 120. I think it hit 120, or it went to 125, and it was at 120 the last time I looked at it a couple days ago. So gold's been just outpacing silver. Silver is poor man's gold, supposedly, which is why I own it, because I don't have any money. I'm poor. So, I own silver. I actually own some silver junk coins as well. About 0.5% of my portfolio is just in silver junk coins. And then my gold and silver is physical. It is not an ETF. It is physical, and it is in a vault. Which that's everybody. Another thing happened during the month is nobody can get gold and silver, especially the retail, smaller, chunks of it. The coronavirus has everything shut down. All the gold bugs and the silver bugs say that the whole physical market is shut down. It's not true. It's the coronavirus and its liquidity. They're talking about how the paper market and the physical market have separated, and those prices have moved. They'll come back together, I'm sure. So I don't really freak out about all that stuff. I'm probably never going to unload these positions. If they get really big or really small, I may add to them or decrease them. But for now, I have no desire to sell either of those. Now, commodities, real life commodities. I do have an ETF. So it's the Aberdeen Bloomberg Commodity ETF Fund. I did a whole write-up on this and why I chose this commodity fund versus another. I'd actually had another one and I sold it and put my money in here. And I'm down 24% since I've been in this. And it's just a mess. I mean, commodities are horrible. They've been for the last decade, they've just been crushed, which is why I'm buying them. That's why I want to own them. Here's my theory. If we do get into an inflationary world, and I don't see how we can't with all the money that's being fabricated, eventually that comes to roost. There's no money velocity right now, and it has created no inflation in the real world. other than, yes, tuition's through the roof, health insurance, everything that the government touches goes through the roof. Well, they're touching money right now. They're printing trillions of dollars, and they're buying up mortgages, they're buying up treasuries, they're just printing money. Eventually that cycles through, and the money's not worth anything. It's already not worth anything. If the money were worth something, yields on bonds would not be zero, which is where they're pounding out zeros. All the yields are crashing down to bottom, to lows. That just points to that the money is worthless, and eventually that just doesn't work. So now, money's worthless. I own Bitcoin, so I've got to write up about why I own Bitcoin. I'm pretty flat on that. I bought an initial position, and then I added, when it ran up a little on me, and I added to it. I've got about 2% of my portfolio in Bitcoin. This is the one that I've got a little extra bond money that I'm trying to redeploy. I don't want to buy stocks. The one that I'm really struggling with right now is adding to my Bitcoin position. I have been listening to podcast after podcast. I've been listening to Preston Pish from the TIP podcast, and I've listened to a couple of live streams that he's done over the last couple of days. And then I listened to his investment. The Investors Podcast did their quarterly, where they do a quarterly with Toby Carlisle, and then they each make their picks. And Preston's pick was Bitcoin, and I everything he says makes sense to me. I'm not sure some of the things he talks about as far as how the world's fiat currency system is going to collapse. It hasn't collapsed yet, so who says it's going to do it now? But he makes a lot of sense, and I do believe that he's right, and it's going to happen at some point. So I listened to Macro Voices with Eric Townsend, and he talks about the same thing, that at some point all the money printing won't matter, and everybody's going to realize it doesn't matter, and it's going to collapse. So one of the things, Bitcoin has that going for it, but it's also got, and I write about all this, so I won't cover it, but I just think Bitcoin, it's not your typical crypto. It is it's kind of the one that makes sense. The rest of them are stupid. A lot of people think Bitcoin's stupid. I don't think. The reason I have 1.9% of my portfolio in it is because I don't think it's stupid. I think there's legs to the story of Bitcoin. I believe wholeheartedly that it could fulfill its mission. It could be worth a lot more. So it's kind of I view it as gold. It's a insurance policy on the fiat money system, which may or may not collapse. But if it does, I don't want to have everything tied up in that. Stocks do the same thing. Back in Weimar, I don't know if I'm saying it right, Weimar, Germany, when you go into hyperinflation, stocks perform decently during that. They get pounded to begin with, but over the long term, stocks, they reprice. Everything that the companies sell gets repriced in the new hyperinflated currency, and everything works out. So stocks are fine too. Bonds don't. That's why I don't want to own bonds. But stocks are going to be fine. It's all going to help you preserve your wealth long term. But I think if you get into some weird situation like that, then gold and Bitcoin make a lot of sense, and they're hopefully not as correlated with. They're hopefully not as correlated. Y'all can be loud. You can. So loud. It doesn't matter. So my family's moving in and out. They're trying to be quiet, and I just told them they don't have to be quiet. There's nobody listening to this except me. It's just me talking. I'll say that again. It's just me. This is just me talking. This is what I do anyway. I'm going to sit here and think about this stuff, so I figured I might as well just think out loud and film it. And that way, if anybody else on the planet Earth even remotely cares, then enjoy. Now, stocks. So I'm going to burn through my stocks real quick. My stock portfolio, do not buy any stock I own because they are really bad. So I've got 6% in international stocks. I usually do not buy individual stocks that are international, but I made an exception for 2. So I own a steel company in Argentina or something like that, and it's down 60% since I bought it. And then I bought Fiat Chrysler. It's down 60% since I bought it. I have sold parts of both of those since I bought them. So I actually made money. Like Fiat, I mean, they did special dividends, and I reinvested some of that. I've also taken some of the money off the table. So, I don't really report all that but I mean, from the day I bought it in August of 18, the price I'm down 60%. Now that doesn't count all the special dividends. I mean, that obviously when I calculate my investment performance, that all gets counted. But just straight price, I'm down 60%. So whatever. I still think Fiat, I mean, it's a well-run company. I think the steel company, it's one of those I wouldn't buy it again, just because I learned a lot over the last 29 months. I've learned a lot about how to invest, and cyclical companies, individual companies, I probably wouldn't buy. You'll see my portfolio over the last several months has switched. I'm getting away from individual stocks, and I'll talk more about this, but I'm really getting away from individual stocks, and really I'm using this Fidelity, the MSCI sector ETFs. And the reason I chose those is they're all, when I buy healthcare for Fidelity, the sector ETF, it's not just large caps, it's everything. So I basically have broad market exposure, basically to everything in the healthcare sector when I buy that. And the fee ratios on it is almost nothing. The turnover for tax purposes is almost nothing. And then I can hold those, and then I can adjust each month when I'm adding money to my account. I can buy things that are out of whack from a allocation target that I try to make. But I've sold out a lot of the stocks that I've made money on, and I'm holding these that are just ridiculous. I mean, I'm not going to sell. Viacom's my biggest individual position, and I'm down 70% in it. And same thing there. I mean, I've added to and subtracted to, but just I'm down 70% from the day I decided to buy that stock originally, which is ridiculous. I mean, Viacom, there's several of these stocks. I mean, we'll look at the charts on them in a second. There's several of these stocks that may go belly up. I mean, Viacom has debt. They've been doing buybacks with debt. They did a merger with CBS. I mean, there's all kind of stuff going on with that thing that have made it more risky than when I bought it. I don't think Viacom is going to go out of business. I mean, good God, they got SpongeBob, for God's sake. So any company that owns SpongeBob ain't going out of business. But you can see Viacom, Prudential got rocked pretty good. I'm down 48% in that. But financials have been destroyed during this past month. Financials, that's another reason I think the market's going to keep going lower, is financials lead, and the financials have been just torn up in this last little run. They were the second worst performing sector. Energy was the worst, because energy always seems to lose 50% every month. Just the way it is. So the financials heading lower faster means, I think, that we're in trouble for other things. TiVo, that's in the tech sector. I own it. I don't know. It's too cheap to sell. DXC, I bought that recently. That's some of these stocks. Let's switch over to, I wonder if I have Domadorian on here. Let's pull that up. Some of these stocks, so one of the things, I don't have my mouse, so you'll have to bear with me, but so one of the websites I look at a lot is this, I'll mess it up, Datarama. But it tracks it's a great website. But what he tracks is all the buying of these kind of super investor guys. And you can see some of these stocks that I'm in, I mean, some of them, and the stuff I've been looking at that I haven't pulled the trigger on, there's a lot of people moving money into them. So top 10 buys over the last quarter. We're starting to get quarter one. So yesterday when I looked at this, the number one buy was Viacom. Now we're starting to get the Q1 20 stuff in here. So Viacom's, everybody's bought that and lost all their money. But over this last 6 months, you can see Viacom. Now, I'm not sure I think the merger may have had something to do with that. And I'm sure there are some super investors like myself that have moved money into Viacom or held Viacom. But I think a lot of that is probably they had CBS or they had Viacom, and then the merger, they had to close out those, and now they own Viacom and report that. I'm not sure about that. I haven't tracked, but there's some pretty big name guys buying Viacom, which makes me feel decent. DXC was on this list for the quarter, so there's been several, pretty big value investing super investor types of guys that have been buying DXC. So it's a tech company that so I added into that. I really, since November, that's really the only thing I've added, because I found that it takes so much energy to research companies, and and then I write about them and I put them on my website and all that kind of stuff, and it's just for the bang for the buck. I mean, what I've noticed is over 3 years, I've had some that have been great performers, and I've done really well, and I made a lot of money quick, and then I've had others that just blew up completely, which I'm not going to get shook out of a stock when it goes down 50%. I mean, I just don't. Not that big of a deal. I mean, I kind of expect that because that's my life in a nutshell. And then there's stocks like Macy's, which I think were over, the downside was already overdone, and then they've just gotten obliterated further because the entire world doesn't think a department store is going to make it, and they may not. But I mean, I ran my analysis, and I haven't really changed my mind on that. So same thing with DXE. So, you can see I'm down pretty big on a lot of these. So 50, 55, 60, 80, 81, 98. I mean, that when the FBI showed up. I mean, what I've kind of learned is that I think when you're buying individual stocks, you don't know. Nobody knows. I mean, there's nobody. The guys running these companies don't know what the hell they're going to deal with. I mean, do you think Macy's knew that the coronavirus was going to come along and destroy them? And no, no, they didn't. Did the CEO of this little oil company, Tusk, oil services company, did he realize that somebody working for him was going to have the FBI show up on his doorstep? No. So that's my point is, me, little Joey sitting in his condo in Nashville, Tennessee, if the guys running these companies don't know this crap, I sure don't. So why am I buying these individual companies and spending all this time, investing my time and energy into it? Even the ones that have been successful, that I've made a lot of money on, it was all just dumb luck. I mean, I really think it's just dumb luck. I mean, I'm trying to buy stuff that's cheap. I'm trying to buy with a margin of safety. I mean, I've read all the books, right? And I may be mucking it up, but I don't think so. I mean, I'm doing everything that you're supposed to do. I'm doing hours of analysis on these things, and you just don't know. And then as I've kind of been making this shift, a bunch of weird stuff happens. So, Warren Buffett comes along, and they get blowed up on Kraft Heinz. I mean, if Warren freaking Buffett can't look at a company the size of Kraft Heinz and get it right, and not have to do a multi-billion-dollar write-down that he just didn't know about. I mean, it's what they said. Yeah, I guess we overpaid for it. We didn't obviously think we would have to do that big write-down. I mean, he's a lot smarter than me. I promise. So another one. I mean, I don't really track Tesla. I don't care about Tesla that much, but I mean, there are lots of people that spend a lot of time thinking about Tesla and how they're going to take over the world. And then there's this entire community that does nothing but try to destroy Tesla. And who's been right? Not those guys, even though they're right. they are right. The balance sheet is garbage. The company's manipulating. They're liars. They lie. They cheat. It's all bogus. I guarantee you, Lucan Coffee, and that just blew up this month. 75% of their revenue. This is a Chinese company. And remember, Chinese, they don't have any coronavirus cases going over there either. So, it's all garbage. So if you think you can sit in your little condo or your big house or whatever, and you can figure all that out, good luck. Because I don't. And I would rather go on bike rides and get in my camper and read poetry. No. I enjoy doing this, but I don't enjoy when stuff happens that is just stupid, that there's no way I could have known about. There's enough to worry about when you buy a company. Are you buying it cheap enough? Is it going to perform? And I just think it's damn near impossible to do it. I think we're all just along for the ride, and it's why? I'll just buy, if I want to own a Tesla or not own Tesla. I don't really want to own Tesla. I think it's a garbage company, but that's fine. It's a part of my Fidelity. I think it's in the industrial sector, so it's in the Industrial Fidelity Fund, and actually it's in probably one of the top 10 holdings at this point because it has risen. It has gone so high as far as market cap that now it's a big holding. And I would have never bought that stock. So all that to say, I think tons of this is just, it is what it is, and we're all along for the ride, and I don't really want to be, but it's too hard to do otherwise. So Macy's, Mammoth Energy, Kronos, Hawaiian Holdings, Airline. It's been fun to own this month. So you don't see any of the good names. I've sold all my good names. We'll go to that next. But I will say, so in November, when I did a lot of noodling in November because I'd come up on my 2-year anniversary of doing this, and I really just started doing my entire investment methodology completely differently in November. I reworked everything, and what I'm trying to do is just where I invest, where I try to match the 25-year average of what the sectors are for the S&P 500. And there's a guy I follow on Twitter, Lawrence Hamtill. He's been kind of been instrumental because I was running in the camp of, I need to buy international stocks because they're price to sales and price to book and all that, they're cheaper. Well, it's because they're not in the same sectors. Like an emerging market, they don't have a healthcare sector. They have 3% of there's no healthcare in an emerging market, whereas in the U.S. that's almost 15%. They have lots of banks. They have lots of financial companies. So they're very heavily weighted to the financials. So you can see kind of the difference. So I look at how, a cap-weighted S&P, an equal weight S&P, a world, and an international and an emerging market. So you can see how the different sectors break out. And what this Lawrence guy says is that really your performance is coming from your sector allocation, and it has nothing to do with whether you're in the U.S. or not in the U.S. And it's all about which sectors. He even says it doesn't matter if you're in small caps, large caps, or mid caps. That it's just what sector are you in. That's what's driving your returns. Now, I do not want to own the S&P market cap weighted because right now that is 23% technology. It is bubbly. It is proven that a market cap weighted index gets bubbly in certain sectors. A decade ago it was energy. Energy was a huge weighting, and if you look at these weightings and how they change over time, there are certain sectors that just blow it out of the technology may be a sector that just is bigger forever, but financials have come and gone. In 2008 financials were a huge part, and technology is now, it's 23%. So, I don't want to be in a market cap weighted because I don't want to be in that bubbly stuff, and I want to be buying the stuff that's cheap. So like energy, energy's horrible to own right now. And that's the stuff I want to buy, the stuff that's cheap. So I'm overweight. Like energy in the S&P is 4%. Well, I've got 9% in it, and the 25-year average is 8%. So the reason I use a 25-year average is it hopefully is getting me out of the stuff that is way overweight, and the stuff that's way underweight, I'm owning it the way it should be. Because over 25 years, those weights matter. And if I'm completely wrong, and one of them's really just, if technology is truly going to eat the world, then that's fine. I'll catch it at some point, but I'll always be kind of underweight it, and I'm fine with that, whatever. Equal weight, a lot of people who don't like market cap weighting, they'll do equal weight, and that's to me, that's dumb too. And I did a write-up about this back in November when I was doing all this that covers why I think some of this works and why some of it doesn't work. I've always said my goal is to beat VT, which is a world, like the world is 55% US and then the rest of the world is the other 40, whatever that is. And then international. So you can see how they all weighed out. And my goal is I just want to use that 25-year average. And one thing I've done over the last few months is I've actually gotten to that, and I match the 25-year average now, which I'm pretty excited about. It took several months for me to get there, and I've tried to do it smart where I'm not buying stuff that's expensive. If a certain sector was really down and on the ropes, I would add to it. And like technology, I was way underweight technology going into all this because I'd bought some, basically I'd been buying value stocks, which were stocks that were they were in energy, industrials, materials. I mean, I was over in the really bad performing sectors, which is part of the reason I've underperformed. So what this should allow me to do is I'll match the performance, if not maybe overperform. So, over several months that's why I bought DXC. I was trying to find a technology company that was a value stock, in my opinion, that was a good value, so that I could get a chunk of money put into that, and then the rest is in that Fidelity fund. So, been working hard on that. Transactions for the month. So, March was pretty busy. So February, like I said, I'd sold out of a little of my commodities. I was way overweight commodities, I felt like. And in February, at the end of February, the market kind of got beat up decently in February. Oh, but there was more. So in the month of February, it got beat up pretty good. So I had sold a little commodities, and I decided I would get that invested in the stock market. And I did. The way it all worked out, I wound up making the investments at the beginning of March. So I put most of that in those Fidelity funds, and I was just getting my sector allocations right. As soon as I did it, literally the bottom fell out of the stock market. It went down 28%. And I say in my little write-up here, I feel like the world literally just exists to punk me, to punch me in the gut, because that's generally how my life goes. But whatever. It wasn't a huge... I was just moving a little money here and there, so it wasn't like I just made this major decision. But still, I just feel stupid. Dino dumb. So the other thing is that so much time in your, I had Micron, Biogen, and then I'd bought the tobacco stocks. I'd bought positions in Altria and Philip Morris, and all those. Some of those I'd sold a little chunks. I'd sold chunks of those at previously. I'd been whittling those positions down a little bit to take money off the table, but I hadn't closed them out, and I was sitting on. I'd made money in all of them, and I just decided during the month of March when the stock market dropped 28%, and then it rallied back up a little bit. And I used that opportunity to close those winners. Those were all winners for me. And I went ahead and closed those officially out. I booked my gains, and I reinvested that into the Fidelity ETFs because those are just 4 stocks that I don't have to think about now. Now, that really was not what I wanted to do in the grand scheme of things. I think Biogen's a great company. I think long-term it'll be a good investment. I think Philip Morris and Altria long-term are going to be great investments, and I think Micron long-term. I love those 4 companies, but it's just the way the market's trading right now. I don't have just book the gain and move on. And then I'll worry about these other stocks. I'll scale out of them at some point when they are not on fire sale like they are now. And they're probably going to go down more. And some of them may go out of business. And that's fine. Because I own the Fidelity. About 2/3 of my equity portfolio is in those Fidelity funds now. So I'm along for the ride. Whatever's doing well, I'm going to do well. And hopefully some of those that have been really beaten up will come back, and eventually they'll outperform over the next little bit. Now, during all that, I wound up having to do some day trading, which was mind-numbing. The last time I did this was back in the 2008 crisis when I was day trading in and out. I had stocks that I wanted to own, and they were just moving, like bank stocks, like Bank of America and stuff like that. They were literally moving 15, 20% a day up and down. And I wouldn't sell my whole position, but I would add to them when they would get clobbered, and when they, in these little bear market rallies like this one, I would just sell out of, I'd lighten back up, and then I'd reload, and I did that, and I was pretty good at it, timing in and out. And I kept my core positions and held those long term. And that's basically what happened here. So when I was selling off some of those others, some of that money, some of these stocks like DXC, Macy's, Viacom, and then I've been messing around with Tusk for a while. Yeah, but those first three, DXC, Macy's, and Viacom, they had been, just obliterated during the month. And all the stuff I look at, so let's look at Macy's. So the way I look at stuff is, I look at weekly because I'm long term, and I bought this, I can't remember when I bought it, but I'm down from when I bought it. It rallied back up, and I should have sold it. Live and learn. But one thing I look at is when I'm looking at these long term just price charts. I do all my valuation and what I think the intrinsic value and all that kind of stuff is. But then you have to look at the technicals to some degree, because you don't want to be catching a falling knife. So when I bought it, what I'm looking for is, I don't really look at RSI that much. I do look at it, but that's just a price movement. The one I really like to look at is, I'll look at the weekly chart over 5 years. And then what I'm looking for it's the money flow indicator, and what it does is it kind of pairs the RSI with the volume, and it kind of gives you a sense of is the stock being sold or is it being bought. So the RSI shows you is the price trending one way or the other, and is it over trend down or over trend up. The MFI puts volume in theirs, and it starts, like you can see all this red volume here, and that the price is just getting obliterated, and you can see that the MFI is really rocking and rolling in a huge downtrend there. So, when I'm wanting to buy these things, when they start pinging along this 20 line there on a weekly, then that generally is a good, unless there's other stuff going on, and with Macy's there has been, but generally that's a price level that's going to stick unless something else comes along. So you can see, it starts pounding along. If we turn on you can kind of see, during this time when it was coming off of in the 30s here. So that was a pretty decent drop there. And then hadn't really done much. The price it's just been a falling knife. But this last price drop was pretty crazy. It was down. It wasn't down as much as Viacom. So if we look at Viacom, it was even worse, and it still is. I think it's Viac. Sorry, I can't type evidently. So, yeah, an 11. So you can see Viacom's been rolling along, and it was trading in 50, and then it got down to $11 a share, and you can see it has been cheap before. It got down to basically 20 there. My son's calling me. He must want to talk about stocks. Let's see what he says. Hello. I'm live streaming on YouTube. Yeah, you're on it. Talking to the mic. I'm just going through my investments. No, I'm live streaming. People they want to watch this. No, it's a live stream. I'm live. I know. Nobody's watching it. Nobody ever will. Yeah, we should probably talk later. We need. Yeah. Yeah, I can. Yeah. I actually almost went out there and tent camped last weekend. And I was thinking about doing that. All right. Let me call you later. All right, bye. I mean, that's my life, baby. See, I ain't got time for all this investing. I got to go tent camping with my boys and shoot guns and stuff. So anyway, when that thing, you can see right here, it got down to 11. It pounded out this MFI. Now, with a falling knife, it doesn't matter. I mean, you can just keep going lower. But like I said, long term, generally, I mean, there is bankruptcy risk going on with this thing at this point. So they've got some debt, and we're in a debt crisis. And they're getting downgraded, like Macy's is getting downgraded and all that. So they're going to be in the high yield market before too long. They're not investment grade anymore. And, that there's a real risk that these companies go belly up. Now, when I'm doing my analysis on them, what I'm looking at is I'm looking at their cash flows, and I'm pretty darn conservative on their cash flows. And then what I'm looking for is, do they have enough cash flow to pay off their debt quickly in normal circumstances? And I look at it over 10 years when I'm doing it, and I get the averages, and I make sure, I'm doing all that kind of analysis. So, unless something crazy is going on, which is happening, these companies are going to be fine. And I think they're going to be fine. But what did we just talk about? I don't know. I'm not the CEO of Viacom. I'm not on the board of Macy's. I don't know. I'm just me. So I'm along for the ride. So too much risk, too much time thinking about it. But why am I day trading these stocks? Because they got obliterated, and that is a massive dump right there. So I took some of that money and I bought into those. So I bought a decent sized position in Viacom. Let me go back to my little thing here. So I bought I closed out the Micron position, and I closed out fully the Biogen position. I'd done that earlier in the month, and I closed out my Altria. I took some of that and I reinvested it into DXC and Viacom mainly, and then I bought a little more Macy's because I wasn't as sure about that one, but I was pretty darn sure about Viacom and DXC. And then I bought a little more Tusk just because that's a lottery ticket at this point. And those they all three bounced between 20 and 48%, all of them. So I sold literally 2 days later, before the transaction had even settled. I sold the entire position that I just put on 2 days earlier. So basically, I'm day trading these stocks. So I still have my original positions. I haven't touched those. I bought a little more, sold it. If they go back lower again, these are positions I will add to. I'm not ready to do that now because I think everything's going to go lower. Could be wrong about that, and if I am, fine. That'll be fine anyway because everything will start going back up anyway. Maybe. So it's very scary times. So close those out. So earlier this year, I closed out part of my silver position. I have physical silver, but I I had such a belief in silver that I actually had a little extra. I put some money in an ETF as well, and I had sold that back in January for a gain. And then Biogen, I had bought it, and I've sold it 3 different times. Right after I bought it, it popped. I sold out part of it at 32%. I was just taking money off the table. And then it popped again, and I got out of that at 54% gain. And then when I finally closed out the position, what was left, I was left with, that was at 46%. So Biogen, I did well on that. I'm completely happy. And like I said, I think 10 years from now, that's going to be a great performing company, and I hate selling it, but whatever. I'm a Fidelity ETF investor. And then both Philip Morris and Altria, I had pretty good positions in those. Both of them had, Philip Morris was up 17%, and Altria went up 23 and 15, and I lightened those pretty aggressively at that point. And I was left with a Philip Morris. I sold it off. It was up 15, and I held on at that time during the month. Sometime this was during the month of March. I closed out the Philip Morris position because it was still up at the beginning of March, and then I held the Altria part of it because I was like, well, I'll just hold on to that. It was down. Philip Morris had kind of outpaced it, and it was down, and I was like, well, I'll hold on to that. And then it was down, and then the market went down more, and it held its own, and then I decided. I kicked myself. I was like, why didn't I sell that day? And it dipped down and then dipped right back up, and I went ahead and closed it out. So that final little tranche of the Altria, I was down 14%, but it had outperformed the market during that time because I've only owned that position since I think it was the end of the year. So I've only had it a couple months. So annualized, I did all right on those positions. And those were kind of quick in and quick out. I do all my trading in tax efficient. I'm in an IRA or something similar to that, so I don't have to worry about paying taxes on any of this stuff. So just do that. And then, like I said, I closed out the Micron position. I had been selling that off and lightening that position to make it smaller because back in November, my position sizes were too big for what I wanted to do. So I've been working on that anyway. The final version of that, the final little tranche that I was left with, I was down 11% when it was all said and done. And I've had that position for several years. And it's gone way up and gone way down. It was trading pretty high. The down 11 was definitely outperforming the rest of the market. And then I just write up kind of what I do with my investments. So all that, every month I just put all that out. So I think I've covered everything there. Yeah. I write about everything I own. There's my write-up on it, so you can click through and see why I like Macy's, when I bought it, and then I'll usually try to update that over time. We looked at Viacom. I mean, that is just, like I said, I'm probably going to add to Viacom because some of these stocks I'm down so far on that the only way I'm going to make money, I mean, you're not going to come back on that chart anytime soon. But if you add to them when they're just obliterated, you have to trust your analysis. You have to reanalyze them and figure out, is this company going to go belly up? So let's look at Viacom. I use this. This is a pretty cool little site. It's got I use Morningstar to pull my 10-year financials. But this site's pretty cool. If I could get it to, of course I can't get it to, because my screen's small here. It's got all the financials as well, but it has some pretty quick, really quick ways. Somewhere on the screen, it's a quick way. I'm usually in a much bigger window. So I'm sorry, I'm struggling here. This is also why I can't do well, because I'm not the brightest bulb. Well, I use Guru Focus and I use StockRow if I want to look at a stock real quick without diving into the financials and just eyeball it and see. One thing I look for is the price to sales and the price to cash flow. I think all the traditional value indicators, price to book and PE ratio, those are all either garbage or can be gamed. And there's so much that goes into those, and everybody talks about that that's not the way the world works anymore. But price to cash flow works. I'm convinced that it is the metric to look at. You can't lie about cash flow, and sales works. You can't really lie about sales unless you're Luke and Coffee, and then you can lie about 75% of your sales, and then everybody can lose all their money. That's another gig at China. That's right, China. Come get me. They'll unleash another virus on us for that little comment. Once I become an influencer, I won't be able to say things like that on YouTube Live. But if you look at the price to sales on Viacom and you look at the price to sales on DXC, you are going to be cuckoo cray cray how bad those are. So, what I'm looking for is I've kept a pretty good position in those. I've added to those as they've been on the way down. And I am catching a falling knife coming and going. None of these individual stocks that I own now, I have any plans to sell. I'm definitely not going to sell any of them when they're down 50%. What I think will happen is they should, if the world doesn't end, and they stay in business, then what they should do is they will return, and I'll probably have overperformance in those over the next 5 years. So we'll see. But if they start trading, if I'm sitting there looking at that weekly chart and all of a sudden one of them gets overbought, then they're gone. No question about it. I want to think. Well, I just wanted to. So this is what I do, and I may do this. So TiVo was one. TiVo, I've got some thoughts on that. The price to cash flow, they have no earnings. So, sorry, there's ads everywhere. So this one, you can see it is, it's been beat up pretty bad. It's getting cheap again. It got pretty beat up in this last little run. Now, I was watching this one closely recently. So they've had merger news that, they're going to merge with another company, blah, blah, blah. And really, I've been watching it all during this time, and it was just kind of pounding along and it was making a comeback here. And that was a pretty good little run right there. And I was like, all right, it may have finally turned and gone the other way. And then right before earnings or something happened, and they drove it down back to previous lows. And then, a week after that, it popped right back up. And I was so mad. I was just like, this is just stupid. Why am I investing in this stuff? Because nobody knows what the hell's going on with any of this. It's all manipulated, and I'm a small fish, big pond kind of guy. So, but it took out and set a new high. And then when everything went to hell, it got rocked. It's a smaller cap company, so it just got destroyed. And it has come back, and it's now sitting at those levels again. Now, I don't really want to add to TiVo, but if it's getting down there, it's down to a 26 on the MFI, which means that people have been dumping it. That's what's happening. That's why the stock's getting rocked, is people have been dumping it. And previously, I felt like that was a good level. That held pretty well. So, they're going to merge with a company, another intellectual property company, and I think the combined company will be better than the separate companies that they have now. So, I haven't really felt like TiVo was a great investment. I shouldn't have bought it. After I did a couple years ago, I bought it. I had a spreadsheet, and I ran all my numbers, and I bought it. And then about 6 months later, I updated all my spreadsheets and realized I was an idiot because I didn't do enough analysis on enough different things to prove out that I should have bought this thing. And at that point I was already down in it, and I was like, oh crap. So I should have sold it then, I guess. I mean, I don't know. It was already down. By the time it gets to this point, like, it didn't really matter at that point because it was already down and it was trading at such a low. I mean, they have cash flow. So when now when I analyze a company, I get really into the cash flow statement, and they're not bad on a cash flow basis. So I'm just going to hold on to it. Sue me. You can't make me sell it. Let's look at Fiat. God. So I'm not going to sell TiVo. I almost did during that one little run right there. FCAU. What a debacle. I can't remember when I bought this. Oh, look. So it looks like August of 18. Whew. It's been a while. So I bought it August of 18. So there. Now, the price chart on this one's kind of kooky because it ran up pretty high. And I think I've sold some of it since then. They did special distributions. I mean, it went on a run there for a while. And then here, I think I added to it here in the 14 range. It may have been during one of those distributions where I added some of the money that was distributed. So they did a special dividend where they had sold, I think, one of their parts companies. They sold it, and they did a special dividend on that. And I think I reinvested part of that, and then they also did on an ADR like this. They pay their dividend annually, so it has a pretty good yield on it, and they paid that. They've been returning a lot of money. I mean, Manish Pabrai owns this company, and he's had it for a lot longer. I mean, it was a lot cheaper when he bought it, and that's one of the reasons. When I ran my analysis on it, that's one of the reasons I bought it, because he's a pretty concentrated investor, and I like the company, I like the story, so I figured, yeah, let's give it a whirl. And it's done well. Right now, it's absolutely... So during all this little sideways trading here, I was like, whatever. Obviously, I mean, the coronavirus has just destroyed that company. They're planning to merge, and you can see the stocks just... I mean, that's pretty nasty. Pretty freaking nasty right there. I have not decided if I'm going to add to that one. I probably will not. It's not even been really on my... I've not added to any of it yet. It is auto companies. I mean, I think in the grand scheme of things, I'm not sure that's where I want to be investing. So I would rather just own a Fidelity sector fund than to own Fiat at this point. And it may wind up being a great investment, and I may be leaving money on the table. Now, TX, so the steel company, we can look at that. Whew, this one's no fun to look at either. The thing with these, so Peter Lynch is probably the most famous cyclical guy. When he talks about the best way to lose half your money is to buy a cyclical at a low PE. So when I bought TX and then Fiat's the same way. It's a cyclical. I mean, when the economy goes south, they get destroyed, and they will lose half their money quickly or more. Well, a steel company is obviously a cyclical. So when I bought this, I mean, I bought it at a low PE. Back in July of something, I've had it a long time. Yeah, about the same time I bought Fiat. So both cyclicals, and what I've learned in my investment journey is you can't use the PE ratio when you're buying cyclicals. And I knew this before, obviously, but that's when I got into really looking at cash flow and all that kind of stuff. But anytime you're buying a cyclical, You just better be ready for the bottom to drop out at any moment, and it has. So when you get into those types of positions, you can do well because you can add to your position at those rock bottom prices, because generally they're oversold at that point because everybody's just completely losing their mind and they're selling them like crazy and they get oversold. And if you're, if you play that correctly, you can make a lot of money because you can buy them cheap when nobody else wants them, when they're oversold, and when the market returns to normal, like it always will, and it always has and always will, you sell out later. I did that in 2008. There was a KMET, KEM. That thing, during the financial crisis, it went to a pennies. And there was no news. There's never any news. The stock just drops 90%, and there's no news. There was no Yahoo article that says something was even going wrong, but it's just they're cyclical, and they get just destroyed, and you just keep shoveling money at them at that point, and because that'll happen. You watch this steel company. It was at 9 during the 2016 recession, worldwide, kind of global, where everything kind of got messed up. And you buy in there, and you're quadruple your money because it's a $37 stock at the top of the cycle. And I think that's where I bought it. Where did I buy it? August of 18. I remember I was on vacation and I was sitting there. I just got my new spreadsheet up and running. I was like, I'm buying low PE stocks. And I think I bought it right there. Cyclical. And then it did that. And I was like, whoa, something ain't right. And then it started doing that. That was I think there was some... This is why you don't want to international companies. I think there was some politician that got elected, and he was going to be a socialist, and he was going to privatize all the company, and they didn't like that. So it rallied back from that when he wasn't going to get elected anymore, and then all hell broke loose again. So no fun. I don't care. I tell you what I've learned is this: is I have a stomach of steel on this kind of stuff. A 50%. The only one of these that really bothering me is Tusk, and I'm down 98%. Let's go look at that chart. This one's where the FBI. How am I going to know that? How am I going to know that the FBI is going to wind up showing up? Because they allegedly, and I don't know if they're ever going to get that money. I don't know if they'll ever get the court battle settled or what. I would not still hold it if I didn't think they were. God, I can't drive this computer. Sorry. Yeah, that is a abysmal chart. So I bought this one at the top. So what Tusk does is they're an oil field services company, so they sell like all the fracking equipment and the sand and all that kind of stuff that goes with that. But they had diversified into electrical infrastructure services, and they're trying to be an industrial company. So they want to get out of the oil business completely and become an industrial company. And they had spun up this division. If you read the annual reports and listen to management, they sound like smart guys, and I'm sure they are. They do all the capital allocation and all the things that you want to hear. They talk the talk. And I'm not sure that they aren't really wise people. That's why I say, hell, I don't know. I've read a lot about this company, and I think I know what's going on with them. So anyway, they had spun up this Cobra division, and they had gone to Puerto Rico to help rebuild the infrastructure when the hurricane blew it up. And they were making money hand over fist and growing like crazy. Well, then, the government decided we're not going to pay for Puerto Rico infrastructure rebuilding anymore. And that whole business line literally just went away. Well, that stinks. And then what happened is they said, well, they had that some officer, the president of Cobra or something, had worked with FEMA in a non good relationship, and that they had gotten the contracts that they had gotten illegally. Well, then that's when the FBI showed up, and that's when it did this drop right here down to 6. I think the FBI actually showed up here, and then they really showed up here. So at that point, just lost a ton of money. Business division went away completely, and has not come back. I mean, there have been hurricanes since then. They should be able to go out and do that still, but it's gone away. Couple $1 billion worth of revenue in a $3 billion company. I mean, it's not that it was a significant chunk of the company just disappeared, has gone off the grid. Now, they should be able to spin that back up. They've got all the equipment still. We'll see. But the other big issue with that is some of the receivables from those contracts are not being paid yet until they get through the court battle and figure that out. And it's a sizable chunk of money sitting on their balance sheet. So at this point, I looked at it again when it dropped into the 4-ish range, and I was really noodling on this one again and figuring out if they don't get paid those receivables and they have to write all that stuff off, are they insolvent? And from what I could tell, no. They could weather that and still be fine. I don't guess anybody agrees with me on that, because the Tusk has been just, the price of oil has collapsed. The fracking business is collapsed. That all happened after all the FBI showed up. So, it got into this range right here at about $1.50. And I was active in that range, adding, if they get paid the AR from the Puerto Rico stuff, the stock will pop. If they don't get paid, I still think it's worth more than $1.50. But that's all. But I have not looked at it again since all this oil price collapsed down. I mean, oil's off like 50-60% this year, which is why the stock has done this. So it's in the oil. I mean, it's a small cap, and it's in the oil services industry, and that's literally like the worst performing sector in the entire stock market. So I'm not selling that. I'll just lose everything in that one. It'll probably get delisted, and then I'll wind up having some freaking dark stock that I won't even be able to keep track of, but whatever. It's a lottery ticket at this point. I still maintain that I believe the management team is competent and good capital allocators. I also think they've been through this before. They went through the 16 thing. Their balance sheet was a lot crappier then, and they made it through that and came out growing. So we'll see, but I think they will weather. I mean, they're just getting they're getting a lot thrown at them right now. The stock is obviously destroyed at this point. I don't know. I may add to it. What the hell, right? DXC. I mean, if you looked at the Viacom chart, you saw the DXC. We may have already looked at DXC. I'm probably just babbling at this point, but I don't know. You're the one watching. This is what I do. I look at these charts, and I've looked at the balance sheets, I've looked at the P&Ls, I've looked at all that, I've done all the analysis, on all the cash flows and all that kind of stuff. And then it's just price action, and you have to update that, but you don't have to update that. I mean, I'm looking at 10 years of data and looking at those trends over 10 years, and the businesses are not changing that much in 6 months. So, I'll update that once a year. And other than that, it's just price action. So DXC, technical consulting company, supposedly helping people convert their systems to cloud, which obviously everybody and their mom's doing right now. Now they're in a turnaround. They're evidently really bad at what they do, and they've got some pretty ticked off customers. they've got a new CEO, and who knows? Who knows if he's going to get all that fixed or not? So when I'm buying that stock, I'm buying it with a margin of safety because that may not work. But, I bought this one. What did I buy this one at? This was my new methodology by this point. So the other reason I switched up what I was doing is because I owned, I didn't want to have more than, I tried to position my portfolio for the first couple of years where I had 20-ish positions. And what I found was when a stock would get tore up, then I was having to shovel money into a pretty big position. And I usually don't add to stocks after I buy them. And with the type of stocks that I buy, I need to be able to add to them when they get rocked, because as you can see, most of them have. But I was kind of tapping out. My fund was committed. So what I'm doing now is, I basically by sector, I weight, the way I want to be weighted by sector. And then if one of my stocks, basically I say within the sector, I can own 25% in one stock, 25% in another stock, and the rest will be in that fidelity. And then when I'm adding money to my portfolio each month, if I'm doing a contribution, then I can decide to add to a individual stock, and they're going to be a smaller, so I can throw money at these problematic stocks that I'm still convicted about and still want to own, without having to really make huge moves in my portfolio. And then for something like Tusk, where if one of the companies is really just a bad investment, that was impactful for to lose 98% in one of your 20 stocks. That's a large chunk of money. So just over the couple of years, I've just realized that I think it's luck. Because there's no way you can analyze that and be right or wrong. It's just luck. And I don't need to deal with that. I already own a real company, and I have to go work there every day. And that's enough. Believe me, we got enough problems. So I think we've looked at all of them. We looked at Macy's. Oh, coal. That's a great industry. We got to go look at the coal stock, ARLP. So this is not regular common stock. This is a partner, MLP, a master limited partnership, which makes it even more fun because it's not even like a real stock. The way you report your taxes is completely different. So, it's already got its MLP, which has different tax consequences and different, payout ratios because of that. And then it's in the coal industry, and they are one of the largest providers of, coal guys. They're pretty good balance sheet, pretty good. I like management. They own it. I think it's a great company. The problem is it's in the coal industry, and that their biggest customer is China. And what have we been doing with China except pissing them off for the last 6 months with trade wars and whatnot else? So they've quit buying coal from us, I guess. And then the price of gas has been collapsing. So, who in the hell wants to buy coal when you can buy natural gas for... What did I see the other day that somebody was talking about they could buy a pizza for... that a pizza was more expensive than a barrel of oil. So, in that scenario, coal, everybody hates coal anyway, which is why this stock was cheap and already cheap. And now it's just absurd. So I will add to this, because, if you go read my write-up on this, I'll be damned if coal's going to go away. I don't care how bad all the Green New Deal people want it to go away and all that, but coal's not going away. We will figure out. It's not going away. So, not going to happen. So it will not be a $3 stock forever. It is completely oversold right now, and noodling on this one today. Actually, I was looking at it and thinking that would be a good place to move some of that bond money over. So, like I led off with all this, I didn't. But that's why I look at this stuff and think about it, because that's just how absurd that is. It's got a really good yield on it. The rules with the MLPs are they have to distribute earnings, and to do that they get favorable tax treatment. So that's why they are structured that way. And they used to have two entities, and they combined them. So, like I said, I think the management team knows what the hell they're doing, and they're smart guys, and they own it. But the big question is coal a valid investment? This is a cyclical on steroids, which is why I bought it. I'd say every single stock that I now hold, I bought into it expecting that it would drop 50% in the snap of a finger, and that they would all probably in a recession like we are going into now, or are in, that they would lose a lot more. So I guess going in, it doesn't. These huge losses, of course they bother me. If you think you can sit on a stock and lose between 60 and 85% of your investment and not feel some regret, then you're out of your mind. But I've not lost any sleep over it. I wouldn't say I expected it. I wouldn't say I expected all of these to do this, because I would have thought some of them. I've sold some of my winners, so I've focused down. The only ones I hold are the ones that are on the ropes. But even with that, I'm surprised with the level of analysis that I did, and the alleged margin of safety that I thought I had. I really am surprised at how some of these have been beaten up as badly as they are. So, that either means I was completely wrong on my analysis, or everyone else is completely wrong right now, or maybe a little both. Mr. Market does not care what I think. So, once a month, I just run through all this. If the market's moving, like middle of last month, I had to update my entire thing again. And I was, like I said, I sold some of my positions. So if the market gets really rocking and rolling, this is a pretty quick run through. I'm just looking at price at that point and figuring out if I want to make some moves. And like we just looked at, there might be. That is a humongous price move, and I don't think it'll stick. I think it will go back up. So on those, what I would do is I'd go look at it real quick. I'm not going to go run the entire analysis again, but I'll go look at it over in this guy, and I'll go look at the price to sales. And it's just, the chart is ridiculous what it looks like. And then I'll just figure out, do I have new money coming into my portfolio that I would want to put into that? And this month, the answer was no. I'm not, with the way the world is right now and the way with my job, I'm not allocating, and I'm not putting money in an IRA this month to lock away until I'm 65. I'm holding on to a lot of cash right now in my personal life in case I lose my job or some crazy shit like that. So, I'm not even doing I've shut down my new contributions on my IRA right now, which is probably not what you're definitely not supposed to do that. But, I'm just not going to. Cash is king in situations like this. And until things settle down a little bit, and then I can be sure, this is not an emergency for me. I have money. I'm not going to, whether I put 1 month's contribution in my IRA this month is not going to sink my financial future. But if I lock it away for 60 till I'm 65, and then I need it in my short-term life, that would be detrimental. But I may change my mind on that tomorrow. Looking at this chart, it makes me want to change my mind right now. So, but that's what I'm looking at. I'm looking at that number right there. I'm looking at this giant drop here, and then that MFI. I've just found that MFI is a great indicator for the way I do my trading. On a pretty long-term horizon, it's a pretty darn good indicator that you've got some major price. That there's a lot of people moving money at that price, and right now there's a lot of selling. If you look at all those bars, there ain't nobody's buying that. Nobody's buying the coal stock right now. It's all selling, and then that's what's creating this humongous price drop, and probably creating an opportunity if you're a long-term investor. So, So, I've been filming for a while now. I don't know if anybody will even find any of this useful. If you did or do, good. If any of these stocks are interesting to you or you have thoughts on them, I'd love to hit me up on Twitter. I would love to talk about them and what your thoughts are on them. I read people's thoughts on these stocks all the time, and I either agree or disagree. But I chuck it away, and it's helpful. So I'll do this. I'll do it at least once a month, just because I do this myself once a month. But pretty much I think anytime I'm sitting down and going through investment-related things, I will probably turn on the live stream and just record that. And if you're on YouTube that night and you want to watch and ask questions, let's go check. This will be funny. Let's check and see if we have any questions. I wonder if anybody... I've never done one of these before. And amazingly, of my 23 YouTube subscribers, I have no one viewing it. And there was no questions during the hour and a half. Blah, blah, blah. So, that's fine. One day, you guys, I will be a YouTube sensation. And you'll be sorry that you weren't here for the first one. Right. But anyway, so there's no questions. But if there ever are, and if I know anything about what the question's about, I would be happy to talk about that or give my thoughts on what I think's going on with that. Now, if you happen to watch this and you have some thoughts you want to have, for some reason, my thoughts on, pop a comment. I promise I'll read it, because I only get one every 6 months. And the next time I do this, which could be next week or next month, I'll cover that. I'll talk about it. I promise. And it will be as good, and that advice you get will be as good as what you paid for it. All right. I'm going to end the live stream. Nice talking to you. No one.